Thank you for joining us for our second quarter outlook. 2017 began just as 2016 ended in the capital markets, namely with very strong equity returns as the major popular indices posted multiple all-time record highs. Now, this is against a backdrop with headlines that would suggest something very different, and thus the title, Economics Over Politics, because there's understandably a lot of uncertainty and anxiety over the political environment right now. But despite that, equity markets continue to climb higher, and to do so, they've done that with incredibly low volatility. And there's a chart that the Federal Reserve puts out that's really interesting. It's not that scientific per se, but what it does is it plots economic policy uncertainty. Three professors have come up with essentially almost like a Google search where they tally all of the words pertaining to economic anxiety and policy risk to the economy. And as you see, it's highly correlated with stock market volatility, which is blue. They're highly correlated when anxiety and uncertainty rise. In the case of the China growth scare back in 2015, so does volatility in the market. China growth scare number 2, anxiety is high, stock market volatility is high. Same with Brexit last summer, anxiety is high and market volatility is high. And what's unusual now is from the election, the two went in opposite directions. Uncertainty spiked and market volatility plunged. In fact, tallying the fourth quarter and into most of the first quarter, we enjoyed the longest period since 1995 with the stock market rising without a 1% sell-off. So it's very, very unusual to see the departure between uncertainty climbing and volatility declining. And this is because investors have focused not on policy risk and headline risk, but rather they focused on the underlying economy, which is improving. Here we're taking a look globally. The U.S. is the blue line, China in brick, and the Eurozone in green. And this is PMI's, Purchasing Manager Index. It's a forward-looking indicator that suggests what economic activity with relate to manufacturing is going to be. And you can see that all of these started picking up late last summer and into the fall. Now, when the election came around, they took another leg up, a little steeper slope. But the fact is the major economies of the world are getting better, and the expectations are for them to continue to get better. So the market's focused on this and focused less on policy uncertainty and political risk. With respect to the U.S. economy, it's on very solid footing and getting better. Whether you look at the unemployment rate, which is at a decade low, household net worth at an all-time high, or the labor market in general, job openings at 20-year highs, and a number that people don't hear much about, job quits. In other words, the number of people that voluntarily leave their job is at a 20-year high. And the reason that is because when people are confident about their job and they have a chance to improve the prospects, they voluntarily quit, and that's at a 20-year high. So this is not the backdrop from which you have to worry about a recession. Things are getting better here in the U.S., though slowly. And so this is not something that continues to keep us up at night, but rather supports the equity market that we've seen. Now, with higher economic growth comes higher rates. We talked about this at the outlook for the year, that we didn't mean to be flipped, that rates are going up, but not enough to matter. But what we mean by that is interest rates, the Fed's tightening, so interest rates will go up, but only a little bit and not so much as to derail the economy. We try to express that, though, because people don't really relate to 10-year Treasury yields, which is what rates in the investment world are usually calibrated on. So what we've done here is taken a look at 30-year mortgage rates and where we think they will go in the next 18 months. And we think we'll see something on the order of a 5% 30-year mortgage 18 months out. Contrast that with what we've seen in the last several years of around 4% on average, so higher. But remember, back here before the real estate bubble burst, we were trending around 6%, so we can certainly have a reasonable real estate market with 5% 30-year money. Now, it's going to slow things down, as the bullet points here suggest. This would translate, based on the average home of being $315,000 in America, that would increase monthly payments on average of $168. So again, slowing things down a little bit, but not enough to derail the real estate market or the U.S. economy as a whole. So rates up only modestly. With respect to stocks, we've talked about this for more than a year. At this point, where stocks aren't cheap, we're trading at 19 times earnings, and we need earnings to grow to support this market, and we think we're finally going to see that. This chart takes a look at earnings estimates quarter by quarter for the S&P 500. So actual is in blue, and over the last couple of years, revision activity has been negative. And beginning last year, we started to see revision activity and actual earnings pick up. such that now the estimates are for some reasonable earnings growth for 2017. We think this is actually going to happen this year, despite the fact that earnings have been flat, fairly stagnant for 3 years. We think this is the year we finally snap out of that. Now, how do we get that earnings growth? Well, taking a look, going left to right, last year, 2016, actual earnings on the S&P were $118. Expectations are for $131 in 2017. How do we get there? Well, basically energy and everybody else. In other words, expectations right now are for the energy sector to contribute $5.50, or a little over 40% of the earnings growth coming from the energy patch this year. The remaining 10 sectors of the market that are not energy are expected to contribute $7.50. So energy is going to be a key component. Now, if you don't buy the energy trade, if you think that we're going to continue to have excess supply, which is not the case, and earnings growth won't come from the energy patch, we still have $7.50 potentially coming from the other parts of the market. So we think this is the year that we finally get earnings growth. Maybe we won't get $131, that's too lofty, but maybe $125, something that certainly will support the current equity market valuations. Now, with respect to equity market returns, the S&P is up almost 6% here year to date, and that's in line with what our expected return base case was for the entire year. Now, remember in January we said that a base case was for mid-single digit. We thought the surprise could be to the upside through not only earnings growth, but capital flows. And to the point of capital flows, we've showed this chart a number of times over the years. This is mutual fund flows and ETF flows in and out of equity funds since the market bottom in March of 2009. S&P's up 250%, 270% or so over this period of time, but you can see monthly data of fund flows. Investors, by and large, have been selling this market all the way, with only a few monthly exceptions. Money has gone out of equities to the tune of $500 billion. And at the end here, you see something's changed in recent months, where fund flows have started to be positive, except for the last 2 weeks of March. We've had decided turnabout in terms of flows, and we think this could continue. This could be a catalyst for further equity positive returns as we progress into the year. So to wrap up, we think the U.S. economy is on solid footing. We think that the earnings picture is actually going to come through to sort of mid-single digit earnings growth for the S&P to support these equity prices. Higher economic growth is going to translate into modestly higher rates, but not high enough interest rates to derail the economy. We think that though asset prices are not cheap, we think it's prudent to stay at the midpoint of your asset allocation range at this point. In other words, on target, if you will, and look for opportunities to reduce risk later on in the year from what we think will be higher equity prices. Thanks so much for your time and attention. Have a great spring, and we look forward to catching up with you in the summer.